Today, I'm going to talk about how I made $1.3 million without doing anything in last 5 years on my rental commercial property. If you are new to my channel, my name is Oberoi and I'm a real estate agent, investor and a serial entrepreneur. I went from working as a server to owning multi-million dollar worth of real estate portfolio in just 8 years. In my career, I have helped hundreds of my clients buy over 900 million worth of real estate using tried and tested strategies, and I am here to share those tips with you on this channel. And why, even in today's uncertain market, these type of commercial properties still make most financial sense. But before I show you the numbers and the exact strategy I used, I wanted to walk you through the basics. Understanding these fundamentals will help you to see why this investment model works so well and how you can apply it too. This is how commercial property value is actually calculated, because this is the key to understanding how I made $1.3 million in last 5 years on my rental property. I'll show you the example. Fair market value. What is the formula? NOI divided by cap rate. So what is NOI? Means net operating income. It's an income which you put it in your pocket after paying all the expenses of the property. Cap rate is called capitalization rate. It is, in the simple words, you could say it is basically a percentage you're getting it versus the rent you're generating in and the purchase price you have put it in. There's two ways you can increase the property value. Either this goes up or this goes down. Okay. First, I will show you what happens if the cap rate goes down and why the cap rate will go down. You buy a property where the area is going to appreciate. For example, 10 years ago in Vancouver, the cap rate was around 6%. Now it is 3.5%. Why? Because in last 10 years, the market value of the properties has gone up. The area has been more populated, more people want to live. Whenever there is more people want to live in that city real estate values goes up. And that's what happened in example. Same thing, let's say you purchase a property in Kelowna, for example, for $200,000 and your cap rate in today's market is 5%. Do the math, $200,000 divided by 5 times 100, your market value of the property is 5 million. Now, let's say in next 5 years in Kelowna, the properties has appreciated, the area has been more populated, more people are coming there. Same thing, if you have a formula of $200,000 and your cap rate has now come in next 5 years for 4%, your property value has gone up by 1 million, because your new purchase price of this property will be 5 million. In the previous example, it was, and excuse my handwriting if you don't, I know I'm not a very good handwriter, but I hope you're understanding the purposes. Now, you have increased 1 million by just having your cap rate going down without doing anything on that property. Similar, same second now, the second way is NOI has to go up. Let's say same property, your NOI has gone up by $10,000. Cap rate has not been increased, which was 5%. In normal circumstances, a person will think of, okay, if the property has only increased $10,000 as a rent in annually, your property has appreciated by $10,000. No, that's not the way to calculate. Remember the formula, NOI divided by cap rate. So now the NOI has increased by $10,000, just less than $1,000 a month. See what would happen. 10,000 divided by 5%, your answer will be $200,000. So by just increasing $10,000 a month, your property has increased by $200,000. So always whenever you're buying a commercial property, you always have to focus on two things. NOI, how to increase, or cap rate, how this can go down. I hope this formula makes sense. Now I'm going to show you the property which I purchased it back in 2020 and how I made 1.3 million on that property. All right, guys, this is the property I purchased it back in 2020 in Abbotsford. It's a standalone building on McCullum Road. This is the property, and I will show you. I purchased it for 3.1 million back in 2020. Closing cost was $62,000. My mortgage at that time was 2.2 million on the property. The down payment I put it is $900,000. Net operating income on that property in 2020 was $147,000. The cap rate when I purchased it at that time was 4.74%. Because it's a redevelopment property, so cap rate was on a little lower side even in 2020. The market value, the formula again is NOI divided by cap rate. So the formula, if you implement that formula, the price is 3.1 million. My monthly NOI was coming 12,250,000. My monthly mortgage was $10,000. So the positive cash flow after paying my mortgage was 2250. Now today's scenario, in 2025, my annual income has been increased to $163,000, even though you see there's not much of a huge significant increase in the rent, but I will show you the real numbers now. Because it's a redevelopment property, there could be a condo building and it's a standalone building. Looking at the comparables nearby the areas, same property, now the cap rate has come to 4%. Remember, I've told buy properties where the area is going to appreciate. So in last 5 years, the cap rate has decreased on that area and now it is 4% cap rate. If I do the same formula, NOI $160,000 divided by 4%, the market value of today, the property is $4,075,000. My monthly NOI has been increased to $13,600. My mortgage is same, it's a lock period, I having it for $10,000. My positive cash flow is $3,600. Every month I'm getting a positive cash flow. So now I'm going to show you what in last 5 years my equity has given me the return on. The positive cash flow, I was getting it into my pocket. If I do the math, actually I did the 3,600 times 3 years only, because that $3,600 every month was not being increased from the day one. It has slowly has been increased. So I'm taking a very conservative approach here and I'm giving with only in 36 months. That comes to almost $130,000. My mortgage being paid by the tenants, the $10,000 which is being paid by the tenants towards my equity, if I minus the interest which I was paying on my mortgage, the number comes to $240,000. My property value has been increased in 2025 is $913,000, which is 4,075,000 minus 3.1 million. If I do it math, the answer is $913,000. Now my total equity has increased. A, B, C, all these three numbers, if I add it on, is $1,282,600. Return on equity. Also one more part, interesting part I want to explain here, it is, when you say ROI, which is return on investment, in Canada and most of North America, actually the calculation should be on ROE, because remember, I'm only thinking of the money I put it in, which is $962,000, which is put. The rest of the 2.2 million is my bank's money. So I'm going to look into it return on equity, which is $960,000, rather than looking at the whole purchase price. So in this case, because I put $960,000, my annually the equity increases divided by the down payment. That's a formula. Whatever the equity has been increased, if you divide it by $962,000, my last 5 years return is 133%. And if I do it on an annual basis per year, that is 27%. You are getting 27% return every single year, even in this type of uncertain market. I don't see these returns like this anywhere else. This is why I'm a big fan of commercial plazas and strip malls, because the numbers don't lie. Thank you so much for watching it. If you're in Surrey, Langley or anywhere in Vancouver area and want to chat about real estate goals, I would love to hear from you. You can book a coffee session with me with the link in the description. I will see you next time. Take care.